stocks, bonds, ETFs, straight out of downtown Chicago. This is Zacks Market Edge.
Welcome to Zacks Market Edge, the podcast about investing in your life. I'm your host, Tracey Ryniec. I'm Zacks Senior Stock Strategist, and I'm the editor of the Insider Trader and the Value Investor Portfolios here at Zacks. And this week, I'm going solo again because I was on jury duty and I didn't know what was going to be happening to discuss the non-AI stocks. Yes, I'm done with AI for right now, so you're not getting any AIers on this episode. But some of you have been asking me for stocks that pay big dividends. You want to get some income, and you're wondering what are some of the top names in this category. Now, you could say some could be AI stocks that fall into this kind of category because why not? But they just aren't paying big enough dividends. So Microsoft, Amazon, and some of the other Mag 7 companies now pay dividends, but the yield just isn't high enough for what I wanted to do with this episode, because you can still keep your money in the bank and get a pretty decent bank rate now on your cash. And while the Fed is cutting, and that is going to impact what kind of yield you're getting at the bank, it's still pretty generous. So you have to really compete with a dividend payer to get the yield. And then, of course, we want only the top stocks with our dividends. So that's kind of an interesting combination of getting the Zacks number 1 rank strong buys and the number 2 strong or just buys. Those are about a little over 800 stocks every day when I'm running the screen. So it's a decent number, but ones that are paying with a big dividend, that's going to really lower it. And what do I mean by big for the dividend? Well, I chose 4% for the purposes of this screen and this podcast. You could do 3. You would get a lot more names at 3 and above, but I chose 4 because if we're going to get a lot of dividend, we're going to get that yield. I really want to get that yield. So it's Zacks number 1 and number 2 rank stocks. Those are the strong buys and the buys, and a yield over 4%. That's it. That's all I put into the screen. I didn't do market cap. I didn't do any valuation. I'm relying on the Zacks rank to give us some companies that have rising earnings estimates right now. Doesn't mean it has earnings growth, just that the estimates are on the rise. We're in the middle of earnings season, so we're going to get a lot of companies that maybe just reported earnings and things maybe are looking a little bit better than the analysts thought for 2025. And so they are raising those earnings estimates. So I put the screen in. Like I said, the number 1 and number 2s will give us over 800 stocks. And adding that dividend yield, it produced 86 stocks. So still quite a big amount to choose from, more than I was thinking we might get with that yield over 4%. But what was in this list? So it was a lot of banks, as you might imagine. The banks are still cheap. A lot of them are paying the dividends again. And so, those are looking kind of juicy here. And then we're getting REITs. Now, what is a REIT? It's REIT, all capitalized, and it's a real estate investment trust. So that is a specific, corporate designation where these companies own real estate. So you're like a landlord when you own one of these companies. And then they are obligated to pay out 80% of their income to their shareholders. So that's why the yield is so high a lot of times on these real estate investment trusts. So there's some of those, and I'm going to talk about a couple of them. And then there's also the master limited partnerships. Many of you looking for income know these, the LPs. And these are usually found in energy. They're usually pipelines, but not always. And that means it's a master limited partnership, which also has its own tax issues. So you really need to consult your tax advisor before you buy any of these like special situations, the REITs or the master limited partnership, because it does have different taxation than just getting a normal capital gains many times. Now, sometimes the companies themselves will put out statements like talking about the tax, what's happening with the taxes on those dividends that they're paying out. So keep that in mind. A couple that I looked at for this podcast did do that. So that's always good information to have as well. But it is still really difficult to get these top type of stocks with a dividend yield over 4%. And remember, for the dividends, nothing is guaranteed. After, 92 years, Walgreens Boots Alliance just slashed its dividend to zero. So it's no longer paying a dividend for the first time in nearly 100 years. So we've seen this in the past where it's looking like, they're paying out more dividend than they're bringing in income. Something has to give, and it's usually the dividend. So you have to look at companies closely when you're getting that bigger yield. For that reason, on this podcast, there were some stocks in the screen that were giving me 12% yield, 14% yield. I pretty much stayed away from those. You can run the screen yourself if you're Zacks Premium and see what they are. But the bigger that dividend yield when you're getting over 10%, usually means maybe something else is going on there. For them to be paying out that kind of yield and to do it consistently. So I know many of you are looking for it as an income stream, and we want to make sure that, it's going to be there for more than just one quarter or 1 year. So that's why I stayed away from those. But everything else was pretty much fair game. And I just kind of looked through the list of names that maybe some of you might be in. And now we'll take a closer look at what do these earnings estimates look like? Why are they a number one or number two? What are the analysts so bullish about with these companies? And then we'll talk about the yield. Okay, so the first one out, I did choose one bank. These are smaller banks that are mostly on this list, which is interesting. I think some of the really large banks like the JP Morgans and Bank of America maybe don't have that yield over 4%. So that's keeping them off. But some of these smaller banks are still being ignored, as they have been since 2008. So one of them that I was familiar with is Washington Trust Bank, ticker WASH. It is a small cap bank, but what it is always intriguing for me with Washington Trust is it's Rhode Island based, but it's regional in New England. But it has been in business since 1800, and they call themselves the oldest community bank that's still in America. So I like these old kind of companies. The management realizes that they've been around a while, so they're trying to keep it going, and they've survived many things, including the, Great Recession. So let's look at what is happening with the earnings estimates on Washington Trust Bank, because this should give us some good ideas. So let's zoom in on Zacks.com. So it's a number two, as you can see. That's what we screened for. It's in the industry banks Northeast. And interesting, the Zacks industry rank, which we didn't screen for, is telling us this is in the top 6%. What? The banks are in the top 10% of industry rank? I've been saying for a while, off and on over the years, the banks are going to come back. The banks are going to come back. But maybe this time, this broken clock will be right this time. I don't know. But to see the industry rank that high is very encouraging. That means many of the analysts are raising the earnings estimates on these banks to get that. So let's scroll down and just take a look at what the price consensus and surprise chart looks like, because this is right here on the quote page now. And they put together a nice earnings streak. They did already report earnings. So we see this little green arrow here in 2025, barely beat 1.7%, but we'll take it. A beat is a beat. But look at the price and consensus. It came way down as the Fed was raising those rates. Then it kind of bottomed to start 2024, but it's been slowly rising here. And you can barely see the 2025 light blue line there. It's just a little bit over 2024, sorry. But look at 2026, which is now starting to show up. It's a nice gain right there. So that's what I like to see. Let's take a look at these detailed earnings estimates, just to kind of get an idea of what those analysts are doing. So this is a small bank. We do have two estimates on it. So that's good to see. There's more than one. And you can see 2025 on the revenue side up 10.4%, 2026, 7.5. This would be good for a bank, kind of slow growing bank. But as most banks are, they're not, super crazy growth machines anymore. But 2025 earnings expect to be up 13.9%. That's very strong for a bank. And then here's 2026, another 15% in 2026. And we're seeing one estimate is down for this year. So that's interesting. But one is also up for next year. So this analyst maybe got a little too bullish about this year and is adjusting, and then maybe was not bullish enough about next year. So just scrolling down, combined with the two estimates, we're at 270. It was 260 60 days ago. And 2026 is at 313 now, up from 312. So these are some good directions. This is what we want it to be, up and to the right. And maybe now the banks on the earnings side starting to turn around. Now the dividend, very generous, $2.24, yielding 6.7%. Now I did say they're supposed to make $2.70, so you do have to watch that dividend payout versus how much the bank is actually making, right? They did say that they've been doing a balance sheet kind of maneuvers recently, which are now done to get them into a more sound balance sheet. So this is maybe what we're seeing here, but they are expected to make more than what this dividend is. But that's something to watch on any of these, as I mentioned earlier. I do like the banks for the dividends. I know many of us have been burned in the banking over the years, including just in recent years when we had, Silicon Valley Bank and some of the big banks go under again completely. But, some of these community banks have survived a lot. Make sure you do your due diligence, read any analyst reports you can get, and check out their conference calls, because that's key too. And then one other metric, let's just look at it real quick. Even though we didn't look at valuations on these stocks, one other metric to look at for banks is the price to book. And analysts always say buy at 1, sell at 2. You can see it's 1.14 right now. So it is on the lower end. So that would also be signaling a possibility of a buy. So that's Washington Trust Bancorp. Take a look at a lot of these banks. As I said, the industry rank is high. A lot of them have very good rank, not just in the Northeast, but across the country. And find your flavor. If you know a bank, maybe you actually bank at some of these small cap banks, that can give you some further insight, of course. It's always good to use the products of what you own. So this one, Washington Trust Bancorp, ticker WASH. Okay, let's move on to the next stock, and it is one I've talked about in the past. I've been following it since the pandemic, but then it kind of went off my radar because this is a REIT, Simon Property Group. It does malls, but it does very exclusive luxury side of the things, malls with a lot of experiences, not the dying malls, but the malls that, are seeing a big boost right now. So they got rid of their dividend altogether during the pandemic. Not surprising. The dividends have come back on a lot of these REITs now, especially the shopping malls, but hotels and various others have also brought the dividends back. But that's something to watch always. Again, it's not guaranteed. If you get something like a pandemic, then you're not going to pay out to the shareholders. Obviously, you're just trying to survive. But Simon Property Group did, and it is one of the larger caps. So their tagline is innovating the future of the shopping experience. They're in North America. They're also big in Europe and Asia, and they've been expanding there. I did see in their recent earnings, because they have reported already, that for 2024, they had record fund from operations of $4.9 billion, and they returned $3 billion to shareholders. So that's what we like. And last quarter, they opened a new premium outlet mall in the US. So they're starting to expand again, and that's good to see. So these premium outlet malls, very lucrative. That's why they open one, and we all like to get a deal. So let's see what is looking like on the actual data that we have. So it's a number 2 as well, which is the buy. The industry rank, since we looked at it for Washington Trust, let's look at it for Simon Property Group, and it's in the top 35%. That's still pretty good because, like I said, these mall REITs had been really beaten down. So I'm liking that things are apparently seeming to turn around here, and maybe have been for a while, but now the analysts are getting more bullish. That's why we got the number 2 rank on it. And then scrolling down, this is interesting on this chart. So I used to be watching it in here, 2020, 2021. It did have a big rally, then gave some of it back, was moving sideways till 2024, where it took off again, was at new highs. Still looks like it's close to beating those 2021 highs still, even though it's pulled back just a little bit here. Did just beat on its earnings by 8%. If you hover over the little arrows, it'll tell you what the beat is and give the date. But here's the price to consensus up and to the right, and it has been moving there over the last couple of years. So it's kind of messy here right at the end, but you can see 2025 up here above 2024, which is down here, but then went up. So I'm not sure what's happening there. We'll take a look in a second. But then 2026, another nice, nice just flat earnings gains. So the analysts kind of know what's going on here, or at least they think they do. This is a big cap, market cap of $56 billion. And since we're on this page, we're going to just look at the dividend. They're paying out $8.40 for a yield of 4.85%. So that's a very nice yield, almost 5%. But let's take a look at those detailed estimates just so we can kind of see what is happening. Going over to that page. So this year, revenue up just 1%. Next year, 3%. This isn't really surprising with a REIT that's, one of these big REITs. They too are not going to be growing at super fast rates. But here, as suspected, 2025 is below what just happened in 2024, but by 4.2%. And then this is in the guidance. They did give guidance that was a little light, which is probably why the shares are down a little bit here. But 2026 back up $12.79 for 2.75. Remember, they're paying now $8.40. So this is how REITs work. It's all Not huge number gains with these big REITs, but you are getting it for the income, which right now is pretty nice. So the analysts, I just scrolled down to look at it. Last 30 days, one is up, one is down for this year. And then for next year, one is up, one is down. Again, they're just kind of tinkering with it because they did come out with the earnings guidance for 2025, which was a little bit light. It does say $12.44, I think, to $12.51 was their guidance range. So the analysts are all at the $12.44. So that's Simon Property Group. If you're looking around and you've been going to some of these malls, you know what's happening. I thought I did. I'm sorry. The guidance was $12.40 to $12.65. So, but it's at $12.44 right here. I thought I wrote down the occupancy in the last quarter was 96.5%. This is key for any kind of landlord, right? That was up from 95.8% at the end of December. So that was the end of the year. And they did raise the dividend this last quarter by 15 cents or 7.7%. And it's payable on March 31st as of March 10th. So you have to own it as of March 10th, 2025 to get this dividend payout. So still raising dividends and things are looking up at the mall. Who would have thought it? But they always find a way, right? And we're all still shopping. Okay, the next company on the list is Plains All American Pipeline. You knew I would have at least one pipeline in here. I haven't looked at this one, so I was interested to see what was going on with it. It is a Zacks #1 rank, and even looking at the style scores, I didn't mention the style scores on the other two because they weren't good, but you can see it right here on your screen. Plains has amazing style scores, A for value, C for growth, A for momentum, and a B VGM. So it's got the double whammy of good style scores and the rank. So that's looking good. But look at the industry rank on the pipelines, top 12%. I haven't seen that in a long time either. Maybe this is just indicating, dividends are in, income paying companies are in now, and the analysts are getting bullish on all these income payers. And they're definitely, seemingly bullish on American or Plains All American Pipeline. Now, I'm scrolling down and let's look at this price consensus and surprise. It's all over the place. It's very messy, but it appears like the price and consensus is going up and to the right. And you can see it here on 2026's estimates. It is right underneath that is 2025. This is another one where you're not getting super spectacular earnings growth per se, but it's usually a little bit slow and steady. So this is a little different that suddenly, all of these estimates are being revised higher at the same time. So that is bullish. That's why it's got the Zacks #1 rank, the strong buy. And just scrolling down, market cap of 14.1 billion. So this is a pretty big cap company. Dividend of $1.52, yielding 7.56%. So this is a master limited partnership. So again, consult your tax advisor on what is going to happen with that dividend and that yield. But they describe themselves as owning midstream energy infrastructure and provides logistics services for crude oil, natural gas liquids, NGLs, and natural gas. They're in the US and Canada, and they process or deliver 8 million barrels a day. So these pipelines are back in the news with the possibility of tariffs going on. They haven't reported earnings yet, reporting on February 7th. So that's a couple days after I'm recording this podcast. So you may see differences in what the analysts are doing. But this is interesting that we have the Zacks number one rank ahead of the earnings report. So I have to scroll down now. We're going to the detailed estimates. And 2024, we only have one estimate on 2024 still. But 2025, we have 3 for revenue side, 5 for earnings. So yeah, the analysts have been adjusting, and we're in 2025. So the Zacks rank is picking up these adjustments on this current year, and one is higher in just the last week ahead of earnings. 3 are higher in the last 30 days. Now, if you look at what is happening with the earnings, it's expected to be $1.56 for 2024 and decline a bit to $1.47 for 2025. But like I said, you're not seeing a lot of earnings growth usually with the pipelines. But, this year for 2024, at least 9.9% on the earnings growth side. So that's not too bad. But just scrolling down a bit, you can see 2025, because we just had that one that raised, it is on the increase here, like it showed in the chart. We are seeing a bit of an uptick here. So we might get more of that after this earnings report. So we'll see, are these analysts still being too conservative? And are we actually going to see some earnings growth this year compared to 2024? It won't take much to get us there. Only 9-cent difference. So that is the pipelines. A lot of people like the pipelines for income because they are pretty steady eddies. Not a lot of cuts ever made to those dividends. They just keep, shipping the oil and the natural gas through those pipelines. So they are considered to be rather boring by many people. But sometimes boring is good if you want that kind of income. And remember, the dividend is $1.52. They're expected to make $1.56 and then $1.47. So that dividend's probably gonna, vary maybe in there. I'm not sure, but I'm gonna be tuning into this one on the earnings myself to kind of see what is going on. But you can see, returning back to the chart again, it is up and to the right, even for the share price, and the shares are at 5-year highs here. So everybody's diving in, trying to get income. Forward PE of 13.7. But something good has been going on at these pipeline companies to get in the top 12% on that industry rank. So that's Plains All American Pipeline, P as in Paul, A as in Adam, A as in Adam. Okay, let's go on to the next stock, Park Hotels and Resorts. Yes, I'm a big fan of hotels. I was following these during the pandemic as well. Stocks chart looks very similar to what the retail mall REITs look like. A lot of these cancel their dividend, trying to save themselves as hotels mostly shut down. So a lot of stresses and strains on these hotel REITs. So these are a little different than what goes on with the hotel chains. Hilton, Hyatt, Marriott, those stocks traded publicly separately. A lot of real estate REITs actually own their hotels and then license out under the names. So Park Hotels and Resorts does own some of the big companies, hotels, and they are 40 premium hotels and resorts, and their strategy is to acquire these upscale resorts. However, like I said, they did have some stresses and strains. So that 40 number does actually exclude the Hilton San Francisco Union Square and the Park 55. Those are in receivership from the pandemic. So it does not, the 40 doesn't exclude or doesn't include those two hotels. But luxury is a good place to be, especially on this surge in travel. A lot of people still with money still are out there traveling to these types of luxury hotels and resorts. So let's take a look what's happening So it's got a Zacks number 2 rank, actually pretty good style scores, A for value, D for growth, B for momentum, and a B overall. But look at where this industry rank is, bottom 32%. And it's in REIT and equity trust. It is a REIT other. For some reason, it's in the other. There is, I believe, a hotel one too. So I'm not sure why this one is in other, but the other isn't good. It's the bottom 32% here. I'm just kind of curious. You can click on this link and see who else is in here. Okay, so some of the other hotels are in here too. I'm not sure why. I'm going to have to look into that. But we see some gaming and leisure properties, some healthcare is in this other category. So infrastructure, Brookfield is in here. So how many total? 92. So maybe everybody's in the other. Other could mean the hotels. So like I said, this is a Zacks number 2. There's only one Zacks number 1 rank. That's why it's at the bottom. When you have more companies, number 1s and number 2s in that industry, the industry rank is going to be higher. So only one, and it's Diamond Rock Hospitality, ticker DRH. That's the only number 1. But we didn't choose that one. We have Park Hotels and Resorts. And this is a big cap. Oh, no, it's not. I thought it was much bigger than what it is. Market cap of just 2.7 billion. So I would say that's almost a small cap stock here. So very different from Simon Property Group, which is a big cap. So this is on the smaller side. And you can see on the chart, very good earnings surprise track record. And here's the earnings up here. So it is it's kind of going sideways, but it is off the highs from 2024. So the analysts got a little bit too optimistic about 2025 and 2026 in 2024, and they've been cutting a little bit, but here you can see a little bit upward tick there. So that's maybe where we're getting the better Zacks rank. It hasn't reported earnings yet. Down here showing earnings on February 19th after the close. So we're waiting on that. But what is happening to get us the number 2 rank here is the analysts just getting more bullish. What's happening? So we still have 2024 showing up because they haven't reported yet the full year. And one estimate there is down in 60 days. But look at 2025. One is higher. And there's some momentum there in the last 7 days. We do have it mixed over the last 30 days, though. One is higher, one is lower. But that one that's higher is seemingly giving it the momentum to get the number 2 rank. Now, 2024, we're looking for 207, 2025, 222. So a little bit of growth there. Right now, it's showing 7.37% earnings growth. But again, on these hotel REITs, it is more difficult. You're not normally getting like a double digits unless they're out buying, new hotels or resorts that can really add to that earnings, which they do. There is a lot of buying and selling. Sometimes they'll renovate a resort and then they'll sell that to another REIT and then use that money to get in somewhere else. Sometimes it's just geographical, certain cities they want to focus on versus others. But remember, all hotels have added extra expenses of renovating. And when you go into these earnings reports, you'll see like we're spending $100 million to renovate, some flagships, say like the Drake in Chicago. That's not one of their hotels, I don't believe, but that would be like what you would see. And because they're older classical hotels, you got to do renovations every number of years and it's costs a lot. So some of that goes on with these hotel REITs. So keep that in mind, but not all of them own these big older classical hotels. A lot own the smaller, newer ones. And so it's hit or miss, and some other hotel REITs were on this screen. So definitely take a look at others if, it's in a geographical area you don't like, or, you don't want any of those older hotels just because of the added costs. So their dividend is $1 and it's yielding 7.6%. So I'm liking that. that is, well under what the current estimate is. Like I said, for 2024, it's $2.07. So, and this chart is indicating that it might be cheap. Forward P is just 5.9. You can see the stock is trending way under where the earnings are going. So the street is still somewhat bearish, but the analysts getting more bullish. So I like looking at stocks like this: Park Hotels and Resorts, P as in Paul, K. And we're going to wrap it up with another interesting name, a retailer. I've talked about this many times because they've been very consistent with their dividend. Also one I followed during the pandemic, Ethan Allen Interiors, ticker E as in Edward, T as in Tom, D as in David. They had to change their ticker because it used to be Ethereum and people got confused. So now they're ETD, Zacks number 2, and stock score is pretty good. They have already reported earnings. So analysts been messing around with these earnings. A for value, F for growth, A for momentum, B. Okay, so why did we get the F for growth if things are going pretty good for Ethan Allen? Because it is really being hit in sales by a slowdown in housing. So you go out and you'll buy that new couch or bedroom furniture. Normally when you move, when you buy a new house, you want new things. And this really boomed during the pandemic when everyone was moving. And then it kind of crashed down. All the furniture retailers knew, hey, this isn't going to last forever. It's fun while it lasts, but we knew it wouldn't. But they've been mostly in a recession since 2022 when the Fed raised those interest rates, the mortgage rates spiked, home sales slid 30-40% in some cases, and they're still staying pretty low in most places. But the furniture retailers see light at the end of the tunnel, and they do see that things are going to finally move out of these kind of dark times, and they're ready. They're ready for better business. And Ethan Allen, 172 retail design centers now. 75% of their goods, their furnishings, are manufactured in North America facilities. So not necessarily in the United States, but North America. They do believe this gives them some edge on the tariffs. They were not manufacturing mostly in China, for instance. So they didn't have to move manufacturing as some others of their competitors, like RH, has moved its manufacturing out of China after, 20 years of doing business there. So Ethan Allen, not that same scenario, but I'm not sure how much they have in Mexico or Canada. So that could be in play depending on what happens with the tariffs. So these are all things to watch with Ethan Allen, but let's scroll down, see what's happening. So despite the rather darkish times in the industry, and you can see 2022 over to 2025, the shares have basically gone nowhere during that time. But I've been waiting for them to drop. I thought with the earnings finally declining, which you can also see on this chart, since 2023, they've been on the decline as the furniture sales have dropped. I thought the shares are going to drop at some point. I'm going to get it a lot cheaper, but they really haven't yet. So this is a flip side of Park Hotels and Resorts. The street is much more bullish than what the actual earnings outlook was looking like, probably because they know it's going to turn around at some point. It looks to be like we're closer to that point now. So this is a small cap, market cap of $778 million, dividend $1.56. That's yielding 5.09. or 5.1%. Very nice dividend. They've been dividend friendly throughout the pandemic and over all the years. They said last quarter they paid $10 million in dividends. That was their fiscal second quarter. And they ended the second quarter with $184 million in cash and no debt. That's why I've always liked Ethan Allen, no debt. And they got the manufacturing in North America. So it's kind of an interesting combination. Look around at a lot of these furniture retailers. They have pretty good balance sheets, actually, and they are shareholder friendly. Some of them have been paying out dividends for decades now, and they have no intention of stopping that. And when this business turns around, things are going to look good. Ethan Allen has also paid special dividends during the pandemic when earnings were soaring. They paid out very nice specials. So while no dividend is guaranteed, obviously, if you got a good balance sheet, things can look good for those looking for income. So let's look at the detailed estimates on this one, because we are getting $1.56. And those earnings were on the decline, but pretty good area here. So this year, fiscal 2025, we are in it. We only have one estimate, so very few covering these furniture retailers and these small furniture companies, but we do have one. Earnings expected to be down 6.8% this year because we're only just starting to come out of it. And many of the analysts and the industry thinks it won't happen to the second half of this year. They're on the fiscal year. They just reported second quarter, as I said. So look at fiscal 2026, earnings growth of 11.2%. So that stacks up to 232 this year and 258 next year. What will they do with all the cash? We don't know. But this would be nice to see as someone who's a fan of housing and these furniture retailers. One estimate is higher in the last 7 days. This was after the earnings report. So the earnings report, probably their guidance, their comments on the call gave, the green light to be a little more bullish here as we are heading into the back half of this fiscal year. It's up 2 cents. And then next year, it's up another 3 cents. So I like this area, as I said, and it's got good style scores. This is in the top 35% of the industry rank now, because we're seeing this turnaround with all these companies in the industry. And just going to curious, out of the retail home furnishings industry, we have Ethan Allen at a number 2. Fortune Brands Innovations is a number 2. Tempur Sealy, that's the bad guys, number 2. And then Home Depot's at a number 2. Some of the rest of these have not yet reported earnings. Ethan Allen is one of the early reporters. We do have some number 5s, but these companies have not yet reported. Either Haverty, HVT is the ticker there, and Lovesac. They make the couches, LOVE. So keep an eye on these as we go through earnings season. There's just 10 companies. Interestingly, RH is not in here. Again, I'm finding out new things about some of these industries. Might have to get that changed and get them over there. And I'm not sure why Home Depot is in there and not with Lowe's. So, but they do carry home furnishings, certainly at Home Depot. But like I said, I like the furniture area a lot, and their balance sheets are stellar. So if you're concerned about the balance sheets, say at Park Hotels, rightly so, given what happened in the pandemic, or even Simon Property Group, again, given what happened during the pandemic, and the banks, given what happened in the Great Recession, or recently with Silicon Valley Bank, then pipelines, a lot more consistent, and furniture is also more consistent. Keep those on your watch list as you're looking for income. And again, remember, none of it is guaranteed. Even Walgreens is now not paying a dividend. And that's what makes income investing a little more difficult. You got to stay on your toes. And if you see these dividends start to be cut, not because, in a non-REIT, in a company that is just like Ethan Allen, just paying the REIT because they can, then that is much more of a warning sign. Some of these others, they have like certain mandates where they have to pay out the 80%. So it may decline a bit based on what the income is doing, obviously. And that's what they have to do. So keep that in mind as well. But let me recap these stock tickers again. For those of you who are listening and not watching the podcast, we had Washington Trust Bancorp WASH. We had Simon Property Group, S as in Sam, P as in Paul, G as in George, SPG. We had Plains All American Pipeline, P as in Paul, A as in Adam, A as in Adam, PAA. Then we had Park Hotels, P as in Paul, K. Then we had Ethan Allen, ETD, E as in Edward, T as in Tom, D as in David, ETD. And if you're interested in more stocks with income, I'm going to be doing a value investor podcast on this same thing. Now, I guess I can't do Ethan Allen again, but that stock is pretty cheap. It's got an A for value. Just scrolling down, 13 times forward earnings is what Ethan Allen. Like I said, I wanted to get it even a little cheaper, but the shares just haven't broken down. So that could be share buybacks. I'm not sure if they're doing it. I think they might be at Ethan Allen as well. So they're keeping it a little bit elevated there with the share buybacks. And I can't get it at 5 times like I can with Park Hotels, but still 13 times pretty cheap. I'm going to have to find a replacement for it on the Value Investor podcast because I'm going to do 5 value stocks that are also paying out. Some of these were values, like I said, but 5 more coming your way on this week's Value Investor podcast. Be sure to tune in there. It's audio only, but you can find it here on YouTube. Find it on Zacks podcast page. It's separate from our normal YouTube page. Just put in Zacks podcast and you'll see all the podcasts in audio form right there on your page, including ETF Spotlight. You don't want to miss Nina's great podcast. She's been covering a lot of AI ETFs over there. So if you still want more AI, we've got it for you. Be sure to subscribe on Apple Podcasts to get all of our podcasts as well, but get us somewhere. And I'll see you again next week with some more stocks.